What's up, guys? Welcome to Just a Tip Tuesday. Today I'm going to talk about a very powerful tax strategy within real estate, especially for high-income individuals. I got a buddy here in the office, Kevin, and he got some new clients that came into him. They had purchased a rental property before, didn't go that well for them. They want to build a real estate portfolio. It's a husband and wife. They're both physicians, high income, and they're looking for the next steps. And so when Kevin asked me about it, I immediately started thinking we should start shopping for some short-term rentals for them. And so why would I want to shop for short-term rentals? Well, the IRS stipulates that when a property is used and rented on average less than 7 days at a time, it's not considered a rental activity. And this is very significant because a rental activity is a passive activity. And so my losses, even paper losses like depreciation, can only be counted against other passive activities. So if I've got this really high W-2 income that comes with a really high tax bill, I can't use my losses over here against my income over here. But with a short-term rental, since the IRS stipulates that this is not rental activity, it is not necessarily a passive activity. Now, that doesn't automatically mean that we can count it against our active income because we also need what they call material participation. Now, material participation is really 100 hours a year. And the husband and wife's hours can both count, and there are a lot of activities that you can do to hit that, and it doesn't even mean that you can't hire a manager. And we can get further into that in another video, but just to give you an idea of how these numbers work out, I can tell you about the property that we actually pitched to them today. So it was a $350,000 ask price. We found this property off market. And so with a $350,000 ask price, and I went ahead and looked up on the PVA what the land value was, it was $35,000. And so you're going to have about $315,000 of depreciable value there. Now, with it being an Airbnb, technically we depreciate that over 39 years instead of the 27 and a half for a residential property. And so in year one, you would have $8,076 and some change of depreciation that you could take in year one. Now, this particular property, based on a 20% down loan at about 6.5%, should still cash flow about $10,000 a year. And so what that means, first of all, it's going to cash flow $10,000 a year. That's great. We should be happy about that. But as far as a tax strategy, it's not a great tax strategy at all because actually what I've got is $2,000 to the good, even after I take my depreciation off. And so it's not a valuable tax strategy at all. Now, if we do a cost segregation study, and that could be a whole other video, what cost segregation is, but essentially what I'm going to do is I'm going to accelerate the depreciation as much as I can. I'm going to take 100% bonus depreciation in year one. And when I ran the preliminary cost segregation study for this property, I was able to get year one deduction of $78,000. Now, as long as we have a short-term rental that is rented on average less than 7 days and I have material participation, now all of a sudden I get to take that $78,000 and I get to count that against my active W-2 income, bringing down my total tax bill. And so the way that shakes out is that should save them, and obviously there's going to be some individual differences in tax situations, but that should save them somewhere about $25,000 to $30,000 off of their tax bill in year one. And so you can see right out of the gate, even a really good deal that's going to cash flow $10,000 a year, even a good deal it doesn't touch what we can do with the tax strategy because by using the cost segregation and the bonus depreciation against their active income, we're actually making 3 times as much money just by paying less taxes than we are off the cash flow of the building. And, you don't necessarily need to be 2 physicians for this. It just happened to be what the situation I'm dealing with today because anybody can use a short-term rental to count against their active income. And that's your tip.